This response has been truncated due to length constraints. Greetings, ladies and gentlemen, esteemed colleagues, voracious readers, and those of you who've navigated the opaque seas of high finance, or at least attempted to, without getting monetarily seasick. Today, I come before you to unpack a tale so rich in arrogance and ambition, it could very well have been conjured up by Shakespeare himself. We're diving into the epic saga that is When Genius Failed, the Rise and Fall of Long-Term Capital Management by Roger Lowenstein. This isn't just a story about money, though billions of dollars are at play. This is a Homeric odyssey that chronicles the hubris of financial wizards who thought they could outmath the market. Let's embark on our own quest to excavate the top 10 insights from this financial thriller, extracting wisdom and retaining a smirk as we ensure hindsight remains 2020. Insight numero uno, even genius has its limits. Oh, they were masters of the universe, weren't they? With enough PhDs between them to remodel the Parthenon, the folks at LTCM boasted of intellects as sharp as Occam's razor. The takeaway here is poignant. Intelligence, no matter how sparkling, can fall prey to the muddier human impulses: greed, overconfidence, and the granddaddy of them all, hubris. Insight number two: the market is an ecosystem, not an algorithm. Our financial virtuosos at LTCM were maestros of quantitative models, believing that the market was a giant calculator susceptible to predictability. What they failed to account for, however, is that markets are living, breathing ecosystems, full of irrational creatures called humans. As it turns out, you can't corner a bear market with differential calculus. It bites. Insight number three: diversification. It's not just for breakfast anymore. One of the big bets long-term capital management made was that convergence trades would always work. That is, they assumed that mispricings in the market would eventually correct themselves. They spread these bets across so many scenarios that they started to look more like a frantic octopus playing multidimensional chess. The takeaway? Sometimes you're not diversified, you're just busier with more ways to lose money. Insight number four: leverage is like Icarus's wings. In our story, the geniuses thought they'd found the magic formula to slay risk and rake in profits. How? By using leverage, borrowing heaps of money to boost returns. But leverage is like wax wings: soar too high on borrowed feathers, and you might just take a sunbath. When the market turned, LTCM's leverage became an anchor that nearly dragged down the entire financial system. Insight number five: the unknown unknowns. LTCM's models were as complex as a Rube Goldberg machine, but they shared a common flaw. They couldn't account for everything. They figured they'd seen every market condition, that they had all the bases covered. And yet, the Russian default happened. The lesson? In the markets, expect the Spanish Inquisition, because nobody expects the Spanish Inquisition. Insight number six: herd mentality is your foe disguised as a friend. LTCM's strategies were so successful in the beginning that they attracted a conga line of imitators. What's bad about being the cool kid, you ask? When the conga line is on a cliff and you're in the front, the view changes pretty quick when the music stops. A market full of copycats is a market poised for a stampede. Insight number seven: transparency is key, especially when you're a black box. Long-term capital management was as transparent as a fortress of obsidian. Investors had faith in the enigmatic box because of the genius resumes behind it. But without insight into the operations, when the going got tough, trust evaporated like a puddle in the Sahara. As Warren Buffett wittily observes, it's only when the tide goes out that you learn who's been swimming naked. Insight number eight: risk management is not just a fancy spreadsheet. LTCM had all the sophisticated risk models and stress tests, but those only work if you listen to them, like having a smoke detector and deciding the beeping is just the machine being overprotectively maternal. Risk management isn't just about calculating risk, it's about managing behavior when those risks rear their ugly heads. Insight number nine: it's not enough to plan for the worst-case scenario. You have to plan for the worster. LTCM knew they were playing a risky game, so they planned for what they thought was the worst-case scenario. But Lady Luck has a hefty backlog of scenarios, including the ones you deem impossible. The geniuses didn't just drop the ball on this one. They threw it into an alternate dimension where physics doesn't apply. And lastly, insight number 10: Pride cometh before the margin call. Let's be clear. LTCM's team was sharper than a sackful of Occam's razors. But in a game where your opponent is Mother Market, the house edge is a humbler pie. Remember, in a humbler pie eating contest, second place is just the first loser. And there it is, dear aficionados of financial follies and triumphs alike, a decathlon of insights gleaned from the yarn that is when genius failed. May these insights serve as a lantern in the sometimes misty path of investing and remind us that for all the advanced calculus in the world, you can't predict the storm that will make the titans kneel. So, before we embark on our next financial adventures, let us raise a glass to the fallen and their tale that continues to educate. May their missteps serve as beacons, and may we tread with prudent shoes upon the ever-shifting sands of Wall Street. Thank you.